7:03. We will go ahead and get started. I love it. Punctual people showing up on a Thursday night to learn about the real estate market. There's Ivan. We couldn't start without Ivan. Okay, he's here.
There we go.
Letting a couple more people in. So welcome. Tonight is our virtual for investors by investors Long Beach meeting. You don't have to be in Long Beach. You could be in Belize. You could be in Texas. You could be wherever you are. But someday we will be meeting in Long Beach once again. Hopefully someday not too far away from now. So that being said, if you haven't been to a FIBI meeting before, we are all about real estate, investor education, and networking with no sales pitch. So we just rotate different topics that we think might be interesting to people in the space, either investing locally or all over the country. We often do panel discussions. Sometimes we'll just do presentations. Tonight, we've got a whole bunch of market data to share. So the idea behind tonight was pretty early after the pandemic broke out, Dave and I did another meeting in the summer, very similar to this one, where we tried to unpack what was happening in the market. We looked at market data on the multifamily space, as well as the single family space. And at that point, I think it was probably too early to tell where things may have been materializing. And so it was a lot of conjecture, but we were still looking at numbers and trying to figure out where things were going. So the idea here was to follow back up on that and do a check-in and see what actually happened in 2020. So that was the nature of the topic that we've got. We're going to go over the same data sets, but updated. My stuff is updated through January of 2021. So we have very fresh data. It's changing all the time right now. And I don't know if anybody really expected the market to do what it did in 2020. We're all actually pretty fortunate that it did. So I'm sure if you don't know that already, then you'll see how that went. So I'm going to cover the multifamily side because that's really what I do every day. Dave is deep into the single family market here in SoCal. So he's going to show us his expertise there with some awesome charts and numbers. He's got a section on California, which I am excited to see because that's a very popular talking point right now in the industry, people discussing where to move capital and so on. But additionally, before we get started, we are going to be doing a full day event that I wanted to make sure everyone knew about. Buckingham Investments is sponsoring it. That's my company. And this is free. I just put the link in the chat to register. So this is not a weekend seminar sales pitch, buy your books on tape or whatever they have them recorded on these days type thing. If you're kind of interested in what we're talking about today, especially in the multifamily space here locally, we're going to have a full day event where we'll have a variety of panels on different topics. We'll talk about financing, investment planning, where the market's going. We'll talk a bit about ADUs. I have an architect who knows a ton about that, who helped City of Long Beach write their ADU regulations to come speak. And then we have some great tax experts as well. So if you're looking to jumpstart what you're doing for multifamily in 2021, we would love if you join us. That is March 13th. That is a Saturday. It's all day. You get a whole bunch of downloads and tools that we use in the course of our business, and it's free. We're not going to give you the hard sell for anything. So hope to see you there. I'll let Dave introduce himself real quick, and then we'll get right down to it.
Awesome. Well, I've got a lot of my introduction based in my slides, but I will say that event, I mean, I've seen you speak so many times, Anthony, and I bet you it's a killer workshop. Congratulations again. Your keynote at IIREC was awesome. I've had so many people talk about how informative that was. So appreciate you presenting that, being a part of that event, and encourage everyone to check out your workshop.
Thanks. Appreciate it. Okay, so without further ado, I am going to share my screen and we're going to dive into some data. Here we go. So if you haven't heard of our company before, Buckingham Investments is a local real estate brokerage company here in South Bay, Southern LA County, really. We work all over Los Angeles, Northern Orange County, Long Beach, all those types of markets. We've got offices in El Segundo, Torrance, and Long Beach. And we specialize in helping people learn all about how to do multifamily investing here in SoCal and write investment plan, do the research, and get out there and buy something. So we're brokers. If you talk to us, that's the way we make money, is just from commissions. So we don't sell education or anything like that, but all of us are also investing ourselves. So we give it all away so that we can create relationships with people, and we don't bite, I promise. So here we are. This is probably the best place to start for market data. So we've been around since 1963, and our company's been big on research since the 60s. So we do local market research on every closed sale, every year, every quarter, and we add this to the chart every year. So I wasn't doing this in 65, but the founders of the company were. And back in 1965, property was selling at $14 a square foot. This is the data that's in this chart is 2 units and above. So this includes duplexes. So it's a little bit different than what you might see in news articles and stuff like that, because most of those publications get their data from CoStar, which really just focuses on the larger properties. That's 5 units and above. So this is duplexes and above. And the market area in here goes from about LAX, Inglewood area down through Long Beach, the southern end of LA County. We have similar data available for the rest of LA County. If you're interested, it doesn't go back as far, because this was really this has been our focus, kind of the heart of our market for 55 years. And so this is just price per square foot of every sale during this time period. And you can see, if you haven't seen this before at some of our other events, real estate pricing somewhat mirrors the business cycle, single family pricing as well. You can see we went up in the late 60s to $18 a square foot, had a recession in the early 70s, boomed up to $86 a square foot, recession in the early 80s, up to 140 a square foot to the early 90s. Had a little longer recession that was a pretty bad one in the early 90s, savings and loan crisis, down to 114 a square foot in 1995. And then we have our subprime boom. This is where probably a lot of us entered the space, and we start to, our memory of real estate investing begins, perhaps, unless you've been around longer. So easy money went up to 329. And then the subprime crash, right? Lots of foreclosures, REOs, all that stuff, down to 205 and up to 422. Finished our numbers recently for 2020. And after going down slightly in 2019, we went up to 422 a square foot on average for the year 2022. That's about a 6.4% increase, which is coincidentally equal almost exactly to the 55-year average rate of appreciation across this chart. So if you smooth it all out and we ignore all these business cycles, multifamily property in this market area appreciates on average just the value of the property by about 6.4% every year. Something interesting that I always like to point out about this, couple things that if you're looking at trends. So we've got 5 decades of values. In my opinion, that's enough to kind of plan for the future and establish some patterns, right? So every time you have a downturn and then a recovery, we always surpass our previous high. So that should make you feel really good if you're a long-term investor in general. Yeah, you can have better timing than others sometimes if you bought in 2007 or something like that. I bought in 2006, was my first investment property, really great timing. But rode it all the way down, all the way back up, sold it for exactly what I bought it for in 2017. And it still works, right? If you hold on to it long enough, you will eventually be fine. And you probably won't have to wait 2 cycles. You probably have to wait 1, no matter when it is. So the message is really, it just pays to get in. By far, participating is going to do you a huge favor versus trying to steal something or just time it. You really can't time the market. The other interesting thing you'll see here is that there's not necessarily a 1-to-1 correlation with the stock market. You may notice that in 2001, the real estate market just kept going up and up and up, but we had a recession in this country. The stock market went down. We had the dot-com crash. So it doesn't necessarily go hand in hand with the stock market. And weird stuff happens in 2020 pandemic times. So that's what we're really going to be spending most of the time talking about and focusing on today, because we look at the past to try and identify what might happen in the future. Hopefully that makes sense. As I go along, feel free to enter questions into the chat, and we will take questions after my section, and then we'll hand it off to Dave, and then he'll take questions on his section as well. So let's get into it. So here's a snapshot of where we ended 2020. If you want this stuff, this is all available. We can send it to you, or it's on the Buckingham site available for download. And these are the metrics that you commonly look at when you're looking at multifamily property. So these are the cities that are in that graph that I just showed you. So we call this the Greater South Bay. It's basically the South Bay and Long Beach. And there were 300 sales in 2020. That's going to be relevant in a minute. The average gross rent multiplier was 16.9. If you haven't heard the term gross rent multiplier before, what that is if you take the purchase price of a property or the sale price of a property or the value divided by that property's gross scheduled rents. And the gross scheduled rents are just the total annual rents for the year. Ignores expenses, vacancy, any of that kind of stuff. So it's an academic number, obviously, but it's a nice representation of the price for the revenue the building generates. So an easy way to think about it is that's the purchase price in dollars for every $1 in annual rent. So El Segundo in fourth quarter of 2020 multifamily property cost you $18.70 for every $1 in annual rent. Manhattan Beach costs $31.20 for every $1 in annual rent, and so on. And what you typically see here is the more desirable, nicer neighborhoods are more expensive. And so the flip side to that, same coin, is the cap rate. So lower GRM means cheaper for the same revenue, higher cash flow. And if you're paying a lower GRM relative to the comps, you're getting a good deal, ostensibly. Cap rate's the opposite. So the higher cap rate means higher cash flow, lower cap rate means lower cash flow. And there's an inverse relationship there between cap rates and values. So the lower cap rate means higher purchase price. The cap rate is a property's net operating income divided by the purchase price, sale price, or value. And the net operating income is the gross scheduled rents minus vacancy expenses before any debt service, which is a fancy way of saying mortgage. So that's the yield that the building's purchase price delivers. And this is an interesting metric because it allows you to compare yields in different buildings, asset classes, areas, even different investment types to each other, and decide whether it makes sense. A really useful way to use the cap rate is if you know what your interest rate is likely to be. Most people want to buy a property where the cap rate is higher than the interest rate or your cost of funds. So if you can buy property at 3.5% right now, which is pretty easy to do, you want to get a cap rate higher than 3.5% because then you're borrowing money and the yield on the borrowed money is higher than the cost that you paid to borrow it. So it's a great rule of thumb in general. So it's hard to make cash flow on Hermosa Beach, Manhattan Beach, and so on. However, because of that low cap rate and high GRM, if you can buy property in those areas and you can increase the rents, you increase the value by twice as much, say, as Inglewood, because every additional dollar in rent that you increase is $31 in value add. So there's a trade-off. Lower cap rates, more appreciation is your value add. Higher cap rate tends to be a little lower appreciation, but higher cash flow. All of these cap rates are pretty low compared to what you would see in other parts of the country. LA is a low cap rate market. And that's just because it's a super diverse economy. We're the third most productive metropolitan economy in the world. We're about $1.05 trillion is our gross metropolitan product, which is after only Tokyo and New York City. So when there's that much demand and that many jobs, that's what happens to cap rates and a limited amount of supply, not enough space for everyone. And Dave's taking advantage of that. He'll tell you all about that. Price per square foot averaged in fourth quarter at $434. We saw the average for the year was $422. So we've continued to go up even through fourth quarter at $434. Price per unit, about $380,000 per unit or per door, as they say. So on to the more interesting stuff. January 2021, snapshot of the same thing. This is very fresh data. It's about the same. It's up even a little bit more. Honestly, these are not statistically significant numbers. This is why we normally do this in quarterly batches. So Long Beach is probably enough to be statistically significant, but where you've got 2 or 3 sales, you got to be really careful with those numbers. So I wouldn't pay too much attention to that. So let's look at some trends. Here we go. So now is when we try to make sense of what's happening right now. So this is our sales volume going back to 2013. So kind of since we were at basically the bottom and on the uptick of the last cycle. This is the number of transactions in that same market area. And we generally bounce around seasonally. Fourth quarter and first quarter tend to be a little lighter. People are thinking about the holidays. Second quarter and third quarter tend to be the busier times. And this has been very even, honestly, in kind of a flat range for most of this cycle. It's been low inventory throughout the cycle. Volume's been pretty good, but then it starts to get interesting in 2020, right? So pandemic breaks out and it just plummets. Tons of cancellations, tons of canceled listings, transactions falling apart. We had the lowest transaction volume in Q2 in decades. So everyone's sitting on the sidelines wondering what was going to go on. And that's when we did the last version of this meeting, actually, I think. So we were all wondering what the heck was happening. We were kind of watching this stuff happen, but the data really wasn't in yet. And we really didn't know what was going to happen. A lot of lenders pulled out of the market, especially in the 5 and up space. It got very difficult to do business for a while. And while that was going on, you know, it was uncertain. There were a few really good deals that got done because people were just afraid. Otherwise, the market kind of froze for a few months. Then lenders come back into the market. Everybody kind of starts to understand what business is going to look like in the era of COVID, that it's okay. We've got PPP comes out, rent relief funds, extended unemployment, all that stuff that we've done for the last year. And surprisingly, collections are pretty good across most of the whole country, including Southern California. And everyone feels pretty good about buying apartment buildings because it's a place to live. Everybody's at home doing what we're doing right now and working during the day. So let's buy apartment buildings. I tend to agree with them. And we see the volume come skyrocketing back. So it's been a crazy year. Q3 busy, Q4 haven't seen volume like this since the beginning of 2018. It's hot right now. A lot of transactions going on, making up for lost time. Definitely pent up demand in the space. GRM, kind of a different story. So GRM's been steadily rising throughout this cycle and has basically been flat since kind of the end of 2017, early 2018. Fluctuations that you could maybe call seasonal. Looked like maybe it was going to be going down again at the beginning of 2020, and then it just kind of bounced right back up as the demand came back into the market. So interesting that that's still there. Debt's really cheap right now, so it's much easier to make deals cash flow, and it's easier to pay that GRM when you're paying 3% for 30-year fixed money, which I've never seen before. So pretty flat. Cap rate, other side of the same coin, it's a similar picture. Cap rates have been basically flat. And so a lot of people have been saying, oh, 2021 eviction moratoriums are going to expire, foreclosure moratoria are going to expire, and there's going to be a mass wave of evictions and foreclosures. And cap rates are going to spike. It's going to be really bad. And that's what a lot of people are waiting for, right? They want to get in, buy low when the market crashes. I tend to think that that's probably not going to happen. So far, the data doesn't suggest that that's anywhere coming for us. I think this chart would look very different in office and retail right now, but you might also be surprised at how well that's held up for a lot of reasons because of the relief funds. I'm interested to see what happens to office and retail as we move along further. There's certainly a lot of for lease signs out there when you drive up and down the major arterials, but it hasn't crashed really either. So, I'm more in the camp that I think interest rates are going to stay low for a long time. and that's going to make it apartments a really attractive asset class. And again, working from home, people need a place to live. Even though it's easier to move now and potentially go to lower cost of living areas, I think it'd be pretty hard for Southern California to lose enough people to make a significant impact on cap rates when we're 500,000 units short of demand in the LA area, something like that. So unfortunately for those waiting around for the getting to get good, the getting is good now. The money's cheap, so go get it. Price per square foot. This is where it kind of illustrates when the deals were from COVID. So I heard a talking point on another webinar I attended a while back where somebody was saying, a client was asking me, well, when were the bargains, or when are the bargains happening from COVID? And the answer was the bargains happened in the first 4 weeks after March 13th of 2020. And that was it. And that was certainly my experience. I had a number of transactions. I think I had about 10 open escrows at that point. Half of them probably canceled, and the other half that stayed in the deal made out really well. Some of those people were able to negotiate huge reductions because both seller and buyer were just totally uncertain about where things were going to go. So there was a very brief period of time when there were a few great deals that got done basically in April of 2020. And then as soon as we kind of figured out that everything was going to be okay, that was it. So inventories remained low, pricing kind of came right back up, as you can see, and we even surpassed where we were. And you saw that we ended in the 422 average for the whole year. So very interesting what happened to price per square foot. This is not going anywhere in Q1 2021 either. Price per unit, same story. Tracks price per square foot pretty similarly. Steady rise through the cycle. Brief dip at the beginning of 2021, and now we're back up. And here's a really interesting one. So I show this last because this is the best leading indicator for what might be happening in the future. So looking at inventory is really one of our only kind of really useful ways for the market itself, for the sale of property, to give us a warning or tell us if it's going to flip and suddenly become a buyer's market. So inventory is really useful to look at for that reason. We're in whatever market you're in. And I took the inventory chart back to 2004 for that reason, because it's a really interesting case study in what happened the last time that we had a market downturn. So this is inventory of everything in the residential income section of the MLS in that same market area, going back to 2004, average number of listings during that year, active and available for sale right now. So you've heard over and over again on this cycle, it's a low inventory cycle, low inventory environment, low inventory environment. When's the inventory coming back, right? It's just, we've been hearing that for 10 years now. And we are still there, very low. Historically speaking, this was pretty normal before the subprime crash, up in the high 500s for active listings at any one point. And look what happens. This is a great warning sign of the market beginning to turn. We didn't really start to see values get affected until we're kind of right here. 2007, 2008 really is when it hit. But even in 2006, 2007, if you were paying attention to inventory levels and you've been in the market for a while, you should have identified that it was probably going to be a buyer's market sooner than later, because the supply and demand scales are tipping. There's more properties to choose from. Sellers have less competition for their properties. Buyers have less competition with other buyers. And that's naturally going to result in pricing expectations changing, and eventually prices go down. Obviously, this is an extreme example, and I can't even imagine what that would look like right now. I open up the market every day as part of like my morning routine with my coffee, right? And I'm like, oh, great. Okay, we've got like 150 listings in the whole market to look at. Okay, which ones are new? And there's like two or three new ones, right? Yeah, I can't imagine what 1,800 active listings at one time might look like in 2008. That's insane. The choice that you would have had at that point just would have been wild. It's hard to even imagine. Really interesting metric. So where we are right now, not seeing it. I can tell you inventory even today is still in that low range. It is tight. It's not looking like that's happening anytime soon. So keep an eye on that. If you think values are going to go down, watch inventory. So the other really popular talking point right now that you're hearing a lot about in the news and in the real estate circles is inflation, right? We've injected over $2 trillion into the economy this year in the form of various stimulus. The Fed has lowered rates to the lowest they've been in a generation. 30-year mortgage rates are in the twos if you're owner occupying something, and 5 and up commercial rates are super low too, low threes or even in the twos. I just closed on a refi today in the twos. I'm so excited, especially watching the 10-year treasury jump this morning. So we'll see what happens. But inflation's the big topic when you have that going on, right? Are we injecting too much money into the money supply? Are rates too low? Are we being too accommodative? And are we going to have a giant boom in inflation down the road or even very soon? So it's worth unpacking that a little bit. So when you think about real estate values and you think about appreciation over time, and you go back to that earlier chart that I showed you that looked just like this one, values and appreciation have two components to them. You have demand and you have inflation. So a lot of what's happening to real estate values is just a result of the value of the dollar eroding over time, which is inflation. And if you back out the demand from that equation by making an inflation adjusted chart of the same values, you get this. So this is that same 55-year chart with inflation adjusted dollars. So instead of $14 a square foot back in 1965, that's the equivalent of $134 a square foot in today's dollars, 2020 dollars, 2021 dollars. So you can see the same pattern is still there. We have an ever increasing level of demand with each cycle, but it's much more even, right? Because we took all of that inflation out of the picture entirely. So it's interesting to look at that. I would look at this in other markets too. If you're interested in other markets, it might be hard to find the data, but the pattern holds true. So that being said, we have to ask ourselves what happens as a result of inflation. So the best example talking about inflation is going back probably earlier than most of us remember investing. So in the 1970s, we had crazy inflation in this country. Interest rates went way up, inflation went wild. They had to raise interest rates aggressively to get it under control. And look what happened here. So remember, this chart is adjusted for inflation. So even though inflation is out of control in the 70s, and that kind of starts in 1971, and I'll show you another chart in a second, starting at $107 a square foot, we're kind of flat, and then it jumps way up. So even the demand towards the end of that decade goes crazy, even if we back out the inflation numbers. So it's really interesting that that happened, because a lot of people think when inflation comes back, rates are going to go way up and values are going to go down. That's what I hear all the time. Inflation comes back, rates go way up, values go down because it's more expensive to buy real estate. The truth is the opposite happened the last time that happened in our country. And so that's why I show this stuff, because it is really interesting to pick this apart. Now, I know that the economic environment back then was totally different than it is now. And there's different fundamentals behind what's causing this in every decade. And so you can't just say this is going to happen again. Like, we don't know that really, right? But I think this is a really interesting time period to examine. So here's an old chart I found that's been laying around our office for a couple decades. And here is the values in real dollars, nominal dollars at that time, overlaid with the 30-year interest rate at that point. So in 1971, we were at $17 a square foot. In 1981, we were at $86 a square foot. That's a 406% increase over that time period. So the earlier chart I showed you was a little bit misleading, right? A lot of people I'm going to back way up. A lot of people look at this and think, oh, wow, that subprime boom, that was insane. That's never happened before. But if you do the math in your head real quick, $114 to 329 is less than 300%. Because of the scale of the chart, you can't see that this was a way larger boom than that one. $17 to 86 was 406%. This was quite a bit less than that. So you have to think about percentage change, because that's the way you should really be measuring this. And coming back here, look what can happen to real estate values when inflation goes wild. Yeah, you're paying 16% for 30-year money, but look what happened to the values. So it's really weird. It's a study in human psychology. But what I've heard from a lot of people is that what happened is that as the interest rates were rising, there's a natural desire for people to get in before it gets even higher. It's bad enough already, but I want to buy property. Values are still going up. I better buy now before we're at 10, before we're at 12, before we're at 16. And people pile in. And this is what happens. So really interesting case study on how that went down. And I mean, who knows if that's how it's going to happen now either, but I always get questions on, well, what happens when rates go up? You know, we have commercial loans are always fixed for 3, 5, 7, 10 years. If they're way higher, when you have to refi, what if I can't refi? Well, think about how the interplay between interest rates, inflation, and future value, along with rents too. Guarantee rents went up aggressively during this time period as well, along with the value of property. So even though you might have been paying a ton for a refi at that point, maybe your rents and your value went up at the same time and it wasn't so bad. I wasn't actually around then, so I can't tell you. But very interesting case study. So if we just think, well, maybe something like that might happen. Sorry, I'm blurry. There we go. Let's look at the rate of inflation in each one of those years. So 1972, 3.2%. Here's the inflation rate in the change in CPI each one of these years from 72 to 81. 10-year average was 8.5%. That's insane. And here's how, just a couple examples from an inflation calculator to blow your mind a little bit. So if in 1973, you purchased an item for $600,000, in 1981, with no other change other than just inflation alone, it would be worth 1.2 million. Or in 1981, you would be buying something for 600,000 that would have cost 293 grand in 1973. Pretty wild. And that's without considering any leverage, rents, cash flow, anything like that. So very interesting. So the measure of inflation for the graph back there, this is just pricing of properties from our old market study. That was price per square foot. And then this was just using an inflation calculator that you can get anywhere to enter this stuff. Good question. So that's the snapshot of multifamily data and where we are right now. My best guess at a forecast, I've kind of mentioned it before. I think we're gonna have pretty low interest rates for quite a while. I think apartments are gonna remain a popular asset class for investors in really all levels. It's a conservative way to get in. Housing is a basic human need, and I don't really expect that to change anytime soon. I personally don't think we're gonna have runaway inflation right away. I think a lot of people don't as well. But if it happens, it's great to own any kind of real estate. So my 2 cents on where we are right now, it's a weird time. It's a weird time, but I think we figured out how to deal with this pandemic thing, how to manage properties, how to collect rents. It's been pretty good. And I expect that to continue. It's going to be really interesting to see what happens this year as we open up. A lot of people think we're really going to have an explosion and that it's going to boom and we're going to have the roaring 20s all over again. But I think we had a lot of work to do on the job growth front and refilling a lot of unemployment. So with that, I will turn it over to Dave to talk to us about the single family market, and I will see if my camera will focus on my face a little better.
Hey, Anthony, before we get started, any insight on rents?
Yeah, that's a good one. I should have included a rent chart on there too. So rents for 2020 have basically been flat right now in our area. So a lot of people thought they were going to go way down and everyone was going to be moving out and cohabitating and it was going to be really bad and collections were going to be terrible. But rents have been about even. In fact, newly remodeled properties that I've put on the market that I own have rented for record numbers that I haven't seen on any other buildings that I have. That being said, tenants and renters out there in the market are short on cash. And they're trying to, whether they have it or whether they're just trying to save and conserve money, they're very sensitive to deposits and move-in specials and stuff like that. So people are generally willing to pay the rent, but we're doing a lot of reduced deposits, move-in specials, and deals so that people don't have to come in with a huge amount of money to move into their unit right away. Large units are doing well because people want the space, but I haven't seen a major problem renting small units either. I have a number of studios in my portfolio and they rent just fine. Vacancy, we have a property management partner that has about 3,000 units under management in this area, and vacancy in their portfolio is at 3% right now. So that's pretty insane. That's a confusing thing for the headlines too, because if you open up articles, you can find articles that say vacancy spiked to 8-9%. And that's true if you include like downtown Class A high rises and new deliveries in the luxury space. But if you separate out that super nice stuff from what we have, the story is very different. Most of our clients and myself have more B and C type properties, and it's been way less affected by vacancies. Leasing's been super strong. Properties are getting leased very quickly once they're rent ready. Vacancies are really low and collections have been good. We have these relief funds available from the federal government that's been administered by the state. That's been pretty effective for those tenants that have developed balances. There's been very few tenants that have actually kind of like played the game with SB 91 and have tried to just squat, basically. That's few and far between. It is happening here and there, but surprisingly little of that going on.
Awesome.
Yeah.
All right. Well, I am going to go ahead and start talking about the residential section here. I'm going to start with sharing my screen. Share. And okay. I assume everyone can see this okay?
Yep.
Okay. All right. So let me see if I can move. There we go. All right. So as Anthony mentioned, we did this report back in June of 2020, and the world was on fire and no one knew what the hell was going on. And, the market, it wasn't in a free fall. It was in like a free hold, like everything just stopped.
Yeah.
And we were trying to figure out where things were going. So I'm excited we're getting a chance to kind of do this again. And let me go ahead and get going here. Oh, there we go. There we go. All right. So first of all, who I am. So my name is David Coe. I am involved in 3 primary entities, how I spend my time. Number one, I have a private equity, real estate private equity company called Capital Stack Investments. We are very focused on development. We are very focused on developing millennial housing. What is millennial housing? Mostly single family housing, some small multifamily buildings, but it's housing that is, first of all, very well designed, housing that is very smart, a lot of tech features, and housing that is green. So those are the types of things that millennials covet when they're looking to buy a house. We're focused here in Southern California, and if you want some more information, you can go to capitalstackinvestments.com. One of the things that we do have on our website, if you go, there's a section where you can sign up to receive a lesson from 50 deals that we've done. So over our investing career between myself and Brian Miller, my partner, who I think is, I saw enter the room here a little while ago, we've just been involved in so many different types of transactions and real estate investments over our careers. So If you sign up every week, we'll send you a deal or a lesson a week that we've learned. So that's the investor side of me. I also run a Keller Williams company called Co-Real Estate Group. We are focused in the South Bay. We mostly do residential. Every now and then we'll dabble in some 1 to 4 multifamily, but it's mostly single family. We work with sellers, we work with buyers, and of course, because of my investor background, we really cater to working with investors. I also have a group on my team that specializes in new home sales. So we're selling a couple of small lot subdivisions, one that we're a partner in through the Capital Stack brand. And then I've got a resale website called coregroup.com. And then we also have a new home sales website called mynewlahome.com. And then lastly, as Anthony mentioned early on, I am the co-founder of the South Bay FIBI group. I'm also one of the partners in FIBI. There's myself, Matt Owens, Jeremy Roll, and Ella San Jose. The 4 of us kind of oversee the FIBI brand. For FIBI South Bay, which Matt and I co-run, we meet the second Wednesday of each month. And if you want to see our meetings, you can go to meetup.com/FIBI South Bay. Our next meeting is Wednesday the something, whatever the second Wednesday is. And what we've kind of moved to in our group now that we're in our Zoom world is we're doing a monthly, more like a roundtable discussion. And this month we actually have Jeremy Roll. We're going to be doing a discussion on the investment passive, the passive investing landscape. So if you're interested in that, go ahead to meetup.com/FIBI South Bay, and you can sign up for that. Today, I'm going to kind of talk about 3 things. First of all, I feel it's my duty to defend California and Los Angeles.
Yes.
Even though the stats show we're in this white hot market, California and LA in particular, I think have been getting a bad rap. So I am going to do my best to defend our homeland.
Do it.
I am going to go over some LA County stats, mostly residential focused. And then I also did a look at kind of the South Bay, Long Beach, just to kind of pay homage to, to our event here. So first thing, right? Everyone is bailing from California. That's what you're hearing. We've kind of just finished off our, I like to call it, the early year real estate investment club cycle. We had our event, the Intelligent Investor Real Estate Conference, a couple of weeks ago. Last week was we had the Best Ever Real Estate Conference, which was a great conference. And then even Keller Williams, who I'm associated with, we had our national conference last week as well. So I've been doing a lot of conferencing virtually the last couple of days, and I'm kind of looking forward to it all being over so I can get outside again and start walking around. But one of the general sentiments that everyone has is that everyone is fleeing California because, our taxes are high and the costs are bad and our politics are bad. So we're going to kind of start off the presentation right now and take a look at what's happening in California. First of all, you probably have all seen this stat before. Anthony kind of mentioned it. Were California an individual country, it would be the 5th largest economy in the world. This is from 2019, and the California economy makes up about that's $3,000 trillion, or is that 3 trillion? No, $3 trillion a year is our GDP, which is 5th in the world. Why? Well, we'll kind of talk about that in a second. Smart person I once heard said that LA had the 3rd largest GDP in the world, right behind Tokyo and New York. And as you can see right here, LA, almost, $1 trillion a year alone in GDP from our city. When you look at jobs, which is one of the most important stats you can look at with real estate, in 2021, Southern California is projected to add 246,000 jobs. That is more combined job growth than Phoenix, Houston, Austin, Denver, and Charlotte, which are all projected to add about 227,000 new jobs in 2021. So this was a strong stat for me. And I think, when you think about California, you have to think about the scale of California, right? When you hear these raw numbers, they look so big, but California has 40 million people in it, right? And our economy here in Southern California is just booming right now. Certainly there are sections that are being affected from the pandemic, but professional services, higher income, higher educated kind of professions are just booming. Here's the stat that you always see from migration, right? Oh my God, look at California. We are #1 in total net migration out of the state of California at 661,000 people a year. But California is also the third largest in in-state migration at 523,000 people a year, right? And I think it's interesting that the #1 place that people go to in California is Texas. And the #1 place for people that come to California is Texas. So I guess people are just kind of confused. They're not sure where to go. I bet you a lot of them are moving back to California this week after the last couple of weeks they've had. Enjoy your low income taxes. We'll keep the sunlight. That's a net of 138,000 a year that we're losing. That's 0.3% of California's population. When you look at the LA County, right, we've been losing jobs for a while in LA County, right? We're since 2017, we've been losing right around, in 2017 is really where we kind of flattened out. In 2018, it's been about 29,000 people a year are leaving LA County, but that's about 0.3% of our population. So LA County still has over, right around 10 million people. Now we're just projected to be just under in 2021. And quite frankly, I drove home today on the 405. If another 35,000 people left, I'm not going to be that disappointed by that. So, I'm okay with that amount of people leaving, but that's what's really happening from a migration standpoint. The reason why is that we have a lot of people from California that are definitely leaving and going to other states. But when you look at net migration, California also has one of the largest inbound migration from other countries, right? So if you look at I think the last year we had this data was like 2017, there was somewhere right around 138,000 people that left California to other states, but we had almost 150,000 people that moved here from other countries. When you look at net domestic migration by income, one of the things that's interesting, and this has been since 2006, who's leaving California? Well, it's people that are mostly making less than $30,000 a year, or 30 to 40,000, 30 to 50,000. You look at this 50 to 99,000, right? But then once you look at 100 to 149,000, you can see that in 2012, we were actually positive in migration, and over 150,000 or more, you're also positive. So who's leaving California? People that are less wealthy, less educated are leaving, and people that are more wealthy and more educated are coming. And that's been a trend for a while, and that's still something that we project that's still going to happen, over the next few years. Oops. Hang on there. Okay. So again, when we look at people that are leaving California, which are the numbers here on the left, people with no high school diploma, they're just high school graduates, that are some college, that just have an associate degree, that has been net negative migration. But when you look at people that have either a bachelor's or a graduate degree, that has been positive net migration. So for the most part, these two figures, balance each other out, which is why the net figure is so low. I think it's important that California is a net importer of highly skilled professions, right? So information jobs, professional and technical services, arts and entertainment industries, those jobs are coming here and growing. We also tend to attract individuals from highly compensated occupations. So architecture, engineering, computers, math, healthcare, legal, science, practitioners, real estate. These are all, careers that you can have in California that if you want to work in them, you can't necessarily move to Boise. Or if you do, there's not a lot of job opportunity for you there where there might be a lot of it here. And then on the other hand, on the other hand, the largest exodus are those in people that are in more blue collar jobs, right? So accommodation jobs, construction jobs, manufacturing, retail and trade. Basically that there's been negative domestic migration in California, cleaning and groundskeeping, food preparation, sales and transportation. And that makes sense. Our real estate's expensive here. Our rates are expensive here. So if you've got that kind of job, why would you want to live in California when you can go basically do that same job and live a much better cost of living? If you want to live here, you have to be in some kind of higher income job, which has been kind of our history for a while. Looking at our population in general, I think one of the other things that's happening is, as a country, and this is absolutely happening in California, our country is getting younger, right? So 47% of the United States population are under the age of 40 right now. The millennial generation, right, which are people born from 81 to 96, is actually the largest generation of all time, bigger than the baby boomers, way bigger than us Gen Xers. And right behind them are Gen Zs, right, that are, right around the same size as the boomers were. So together, these two generations of people are now hitting their, early 20s to late 40s, and they're ready to buy houses. And when you look at migration into California by age, well, those are the people that are moving to California. When you look at people that are between the ages of, let's say 20 and 35, the actual migration into California is positive. When you look at people younger than that or older than that, those people are actually, those are the people that we're losing to other states. I thought it was interesting that this is, the blue bar is LA, the red bar is Orange County. Once you get to over 75, they're actually moving to Orange County, right? So people that are older that really value the weather, they might not be moving to LA, but they love Orange County. And I think that's important because who's buying houses are these millennials and these Gen Y young families that are being started. Right. So last year in 2020, those two generations made up 30% of all buyers. And that trend is projected to increase to almost 50% in the next 5 years. And then what you have on the other side of that are historically low mortgage rates, right? So Anthony was just talking about where rates were back here in the 70s and went all the way up to 16%. Right now, we have buyers for our projects that if they have to pay a mortgage with a 3 in front of it, they think we have tossed scalding hot liquid on them, not realizing how low a 3% mortgage is. It's practically free. But you can get good rates right now in the mid to high 2% for 30-year fixed. And it's just propelling this supply and demand equality that we have in our market. So I think with that part, I think it's important, from a summary perspective is that, and we'll talk about some of this when we start looking at demand here in a second, but in general, we have been in this high demand, low supply market for about 5 or 6 years. That's not a COVID thing. That's something that COVID exacerbated. And the reason why is you've got a lot of young people, the largest generation of all time, that are now entering into their home buying part of their lives. Money is as cheap and free as it's ever been, and they're ready to buy a house. And I think what you're going to see as we start going through some of these stats here, there just aren't many for them to buy. So first of all, and I ran my numbers through the end of January as well. So this is technically February 1st of last year through the end of January this year. And when you look at actual number of sales, we were actually down in 2020 about 3.8%. Now this is LA County. So the first batch of stats I'm going to give you are LA County, and then we'll kind of look at the South Bay Long Beach market in a minute here. So we had 61,000 transactions on total sales that happened in LA County last year. And I think when we look at that by month, we'll all see exactly where that dip was. But it's been pretty consistent for the last 10 years through this whole cycle. Now, this is a look at closed sales by month, and this is since February of 2008. And you can see all the way on the left here, that we actually dripped down below 3,000 total houses sold in LA County in February of 2008. And then ever since then, this number has been going up. And, I think what's interesting, this really shows the seasonality of our market. Like, like a clockwork, in January, people wake up, and by, June, we kind of max out a number of transactions, and then transactions start to dip as the year goes on. And then all of a sudden, in January, we start the ride all over again. That's very similar in a lot of markets. Whoops. But I think what happens in 2020 is where all of a sudden things start to change, right? Like this line here almost lines up almost perfectly with actual number of transactions. And here we go in May of 2020, the market just stopped. And it wasn't like the prices dropped. It's just everything paused, right? And Anthony, I think that was great when you said that the best time to buy a property were the 4 weeks in May of 2020. And I think you're right. And I had one client that got a great deal on a house, and I know he's going to thank me forever that he bought that place then, because the sellers were panicking and no one knew what was happening. And it was a big risk for him. He panicked too, but he got that price way under market value. And all of a sudden, as soon as we started getting some stimulus money in, as soon as people started kind of wrapping their head around what coronavirus was, the market just exploded all the way down to where historically, when we're in October, which is, on the downside of this graph, our peak number of transactions actually happened in October of last year. And then things started quieting down for the holidays, which always happens. But you can see that in May of 2020, prices dropped down all the way to the same level that they basically were in February of 2008. But what didn't happen is we didn't have a price decrease. So when we look at, we'll talk about pricing in a second. This is a chart of the number of active listings by month in LA County. And when we go back to 2008, right, you can see that we had, almost 60,000 active listings for sale. And then as the market started to turn, well, this was actually right around that same time between 2009 and 2010, where we actually had a lot of shadow inventory. There was all this talk of this huge amount of supply that was about to get flooded into the market at any point in time, and it never really materialized. And then people started buying. A lot of investors got a lot of great deals at this point in time. And then we kind of had a bit of a rebound in 2010. It kind of flattened out. And then in 2012 is when the market just starts to take off again. January 2012, I just remember it, we had like 2 or 3 listings that we had held for a while, and all of a sudden I had like 5 offers on it. It was like, wow, what happened? Thank you, January 2012. And since then, our inventory levels have been dropping and dropping and dropping and dropping. So the idea of us being in a market that is supply constrained isn't something that's new for this cycle. There's a lot of theories that people in California, just got to the point as prices were rising. The typical time frame that someone's in a home in California is usually like anywhere from 5 to 7 years, and then they'll want to trade up or recycle something. That number's now been stretched to 12 years over this cycle. So we've got less people selling, a lot of people staying at home. They're not sure where to go. They don't think they can go anywhere else. And then at the same time, you've got this increase in demand coming from all these young millennials that are now first-time home buyers, which historically would buy the house that, the 75-year-old couple was selling because they wanted to downsize and go someplace else. But now that couple isn't selling, they're staying home. And that became severely exacerbated in 2020. Our current number of houses for active listings in January of 2021 is 10,000 homes, right? Which is, there's hardly any inventory at all.
Wow.
This is looking at pending sales by month, and this is since 2016. And I would say that in January, I kind of did the red stars here. We're pretty consistent in the number of transactions we do. It's a pretty predictable housing market. And if you kept going, in 2008, 2009, we certainly had a drop in transactions. But for the most part, we really haven't had a huge increase in the number of transactions that we've had in a while. but we've got all this additional demand from people that are trying to get into property. So when you've got a bunch of demand and you don't have a lot of supply, what's going to happen to prices is that they're going to keep rising up. Looking at the month supply, this is my favorite chart. This is the actual number of months that we have based on the amount of pending sales that we have. And when we look at Los Angeles since 2008, that number keeps dropping and dropping and dropping. The median number of months supply that we have right now is less than 2 months. It's right at 2 months in 2021. And I actually have some slides in here looking at different price points. We'll look at that in a minute. But what a normal market is, a balanced market, is 6 months, right? And that's when you're in a, basically a balanced market between supply and demand, between buyers and sellers. We have been in a seller's market basically since 2012. January 2012 is when all of a sudden inventory started dropping, prices started rising, and that trend has continued. So at some point it will reverse, but we've got so much runway before prices start to get impacted just because we've got this huge pent up demand right now. We wrote an offer yesterday on a property. We were one of 48 offers on a property under the price of $700,000. And that is correct. I said 48 offers. And not only that, people are waiving every contingency, their appraisal, their inspection. They'll hand over one of their firstborn children. Whatever it takes to get into the deal is happening right now. So prices are skyrocketing because they're not being monitored or being kind of tempered by appraisals that are, usually prices sometimes can go beyond appraisals, which will kind of temper the price increases, but not right now. There's so much demand right now that prices are being able to almost rise beyond where they normally would, just because of people that are willing to basically waive their appraisal contingency. Median days on market. In December of 2020, the median days on market for a new listing was 12 days. I'm telling clients right now, when we put your house on the market, we'll have it in escrow in 7 days. And if it's priced right, and if it looks good, and if it hits 12 days, then somehow we failed, because just hitting the median at 12 days is crazy. So again, this is a trend that we don't see changing anytime soon. I think a lot of that is being driven by the pandemic. And I think later this year, once vaccine distribution starts getting a little more widely spread, maybe some older people that have been waiting to sell, maybe they even want to leave California and go to Texas, although they might be rethinking that right now. They can finally start traveling. They can finally start looking for property. They can finally go through the process of selling their home and not be afraid of having people come into their house. All of those things have kept a lot of older people in their homes over 2020, which has been probably the biggest impact on the supply. And I think in 2021, we are going to finally start having some increase in supply, but there's so much demand, it's going to get sucked up in a heartbeat. And what happens to prices? Well, this chart looks a lot like Anthony's charts. Now, mine only goes back to 2008 because I'm not as old as Anthony, who was around in the 50s. Looking at basically since 2009, the average sales price in LA County in September of 2020 hit $1 million, the average. And then it's starting to come back a little bit. October was a crazy month, but I bet you if we do this presentation again in the next 4 or 5 months, by the time we hit March, April, May of this year, I'm pretty sure that price right there will probably be at 1.1 or higher on the average in LA County. I also did a little cross section by price range. I thought this was interesting. So I kind of cut the market in 4 different segments. We have the sub $1 million price range, which is important to me. That's where most of the stuff that we're doing in development, and honestly, most of the stuff that we sell as realtors, we kind of play in this first-time home buyer, kind of sub $1.5 million price range. This is the month supply. Month supply right now for homes that are under $1 million in LA County is 1.5 months. That's the average. When you get to the $1 million to $2 million range, that goes up to about 2.5%. At 2 million to 5 million, it's at 5 months supply. And then at 5 million or more is where you can finally get adequate inventory to buy a home. It's at 12 months right now. So if you don't want to be in a price war for a home, just find $5 million and go buy a house.
No problem.
That's fair, right? Yeah. But even this is dropping, right? Even these numbers are all dropping. Even, at one point we're up to 20 months. Back in, early 2020, we were really afraid of this, this kind of ultra high price point, because you can see that the month supply or day supply of homes were climbing, and then the pandemic hit and no one started selling. So those that did want to buy didn't have any inventory, and that's been dropping ever since that, kind of that March to May timeframe of 2020 as well. Looking at the total closed transactions, this is a kind of a 3-year rolling. So for 1,000 and less, there were almost 50,000 transactions. And really this 2020 number, this is January of 2020. So this is really 2019. So in 2019, we had 49,000 homes that were sold in LA County under the price of $1 million. That dropped in 45 million, but not because we didn't have enough demand for them. We just didn't have enough supply for them. But that was only at this price point. When you look at all the other price points, I thought it was interesting that 1 to 2 million, those number of transactions went up in 2020. When you look at the 2 to 5 million, those transactions went up. And even in the 5 million or more, those transactions went up as well. So where we had a little more supply, the number of transactions went up. But where we really were hurting in supply, which where most first-time home buyers are looking, is in that kind of $1 million range. Those actual transactions were down for the year. All right, so now we're going to take a look at the South Bay. And really what I did is I pulled stats here from 3 associations. So we got the South Bay Board of Realtors, which is the one that I'm a part of, Beverly Hills Greater LA, which is kind of like West LA, Beverly Hills, and then Pacific West, which is kind of like Long Beach all the way down to North Orange County. So that's kind of the geographic region of these stats. And, Pacific West is by far the biggest association. Plus, as you'll see, it also has the highest number of less expensive houses. So of course, when we look at, closed sales, between these 3, from the South Bay Board, we were at 4,600 houses sold in 2018, and in 2020 we were at 4,600. So we were pretty flat. Same number of transactions, even with a worldwide pandemic, we stayed pretty flat. Same thing was in Beverly Hills. They actually had a bit of an increase, and then when you look at Pacific West, they were pretty flat as well. So very similar number of transactions, which most of these. Well, Pacific West and South Bay are very coastal. And then of course, Beverly Hills, Greater LA, while it includes a lot of kind of the, West LA and Adams districts in that part of LA as well, it also does include some very high-end wealthy sections of Beverly Hills and the Hollywood Hills. We look at a price per square foot. I think that you look at, of course, in the South Bay, we were at $498 a foot in 2018. That's gone up to $546 a foot in 2021. And for the South Bay, we were up 6.4% year over year on a cost per square foot basis. Beverly Hills, LA, they were at $643. It finished up at $680. So that's a 5.8% increase. And then Pacific West was at the largest increase. They went up to $414 a foot at 7.5%. We look at month supply. Well, yeah, the same thing's kind of happening. You can see in January of all 3 of these months, there's a little bit of a spike, but that was at the end of January. I can tell you when February numbers come out, that's going to drop substantially, just because everyone that we've been talking to in the real estate industry, the last 3 to 4 weeks, we have seen more demand and more offers being written than at any point in time in our careers. And that's happening in all of our listings. We're coming across more and more competition on the buy side. It is a great time to be a seller of real estate, and actually anywhere in the country, and including Canada. Canada's going through the exact same market dynamics right now. It's one of the things that I learned in the Keller Williams conference that I was at last week. But it is really exasperated here in Southern California. And prices just keep rising. Since 2009, we have been on the steady rise up. This is a rolling 12-month. So, we are all the way up. I think this is the best, right? Beverly Hills, Greater LA. Their average price is 1.7 million. In the South Bay, you're looking, if you want to, be on the beach cities, you're looking at, right around 1.1 is the average sale price. And then if you want to be in Pacific West, which is basically, kind of Long Beach down over to like Huntington Beach, you're looking, you can save a little money. You're looking at, right around that $700,000. But, all these prices are up year over year, rather substantially. And that is the last of the slides that I have. So
Wow.
I am going to leave this up for a second. If you're interested in talking more about, either the investing side or the real estate side, please feel free to send me an email, david@capitalstackinvestments.com. My number's there, and would love to answer any questions you have.
What an incredible collection of data, Dave. Great job.
Thank you.
We did get some questions in as we were going along that I thought were interesting. So getting back to the California question, right?
Yep.
Curious to see the pandemic affecting these migration states, since many white collar workers are now able to work remotely. Income tax in California affects those workers to a higher degree, so that could maybe incentivize an exodus among higher skilled workers. What do you think about that?
So there was actually a study done on this, and I almost put the information in, but it was older data. And basically, this isn't the first time California's had tax increases, right? That's something that we're pretty famous for here. And they looked at where, over the course of history, where, Los Angeles, Southern California history, which is fairly recent. Even with taxes going up, for the most part, migration has stayed flat. And the reason why is our economy is so strong. And what the researcher basically equated that to is that there is so much opportunity here in California to make money that the love of making money far outweighs the fear of paying taxes, right? Because what's the point of paying low taxes if you can't make any money? So when everyone says, yes, we're getting out, we're moving, I get it, right? And again, a lot of older people are, right? People that aren't really concerned about making income anymore. Maybe they're on a fixed income. Well, that's where California doesn't make sense. As far as migration from California, a lot of what's happening is people are leaving LA County and going to other counties as well, right? Because they still may have a job here in LA, but maybe they can live in Orange County, or maybe they can live in Ventura or Oxnard, right? Fillmore, some of these other areas up in the valley, like Sylmar, that area, those areas are having a big increase. There is a bit of a migration happening out of downtown LA. Downtown LA was a booming submarket for a long time. And then all of a sudden, all the restaurants closed and all the law firms started working from home, and the restaurants, if you lived in downtown LA, all of a sudden you lived in a ghost town. Yeah. So those people are selling their condos, and they're now moving out to, North Hollywood, and they're moving out to, other submarkets in the city where they're in more of a suburban community. And that's a trend that'll happen as well. So not everyone that's leaving LA is moving to Idaho or Salt Lake City or Dallas. They just might be looking at getting more space and something that's more economical, by just getting outside of the city core.
That's a great point right there. I think that doesn't show up as often in the statistics, because people like to look state by state and point at that. And I understand why, but we see that even in other dense areas of town. Like we do all this work in Long Beach. And for rents, for example, a 1-bedroom apartment in LA rents for like $1,800 for something really basic. And even if you want to go down to Long Beach and you still have to commute into LA 2 days a week, that same unit's probably $1,450, something like that, which is a big enough spread between rental rates that it makes sense for people to spread out amongst the metro area. So I think you're absolutely right. They're seeing that in an extreme way up in the Bay Area too, where they've had, yeah, some people have moved out of state entirely if they can really truly work virtually 100%. But from my understanding is that people still need to occasionally go in, do meetings here and there. And places like Monterey have been way more attractive. And, yeah, Sacramento is booming right now. And lots of places around there.
Santa Barbara, like those kind of submarkets right now are booming. Yeah, I think one of the things I see, what about businesses leaving California? I have some good insight on that, because the reason I got into real estate is when Nissan left California and moved to Tennessee, I was actually still working in the automotive advertising space. So they moved to Nashville, and 19% of their workforce moved with them. That means that 81% of the people that worked for Nissan stayed here in Southern California. So even when businesses move, it doesn't mean they're moving every job with them.
Right.
And the reason why is if you are a young executive working for Nissan and all of a sudden they move, well, where are you going to get a job for a young executive working in an automotive space? Detroit? Well, no, you're not going to move to Detroit when you're from Southern California. You're probably going to find a job at another automotive company here in Southern California. So that was what happened to most of their workforce when they moved. It doesn't mean jobs aren't leaving. Again, there are jobs leaving, but you saw the prediction and projection for jobs in 2021 is still at a rate that's higher when you combine all those other submarkets together. So there's still so much opportunity, and there's the economy here is so strong. So many jobs are being created that it is absorbing whatever job losses we lose with other opportunities from other.
I think that's a great point. And for another couple examples on that, CBRE made headlines by moving their headquarters to Dallas. They're the largest real estate brokerage company in the world. And that was a big deal, but it turns out that they're basically not really moving any jobs there. They already had a giant presence in Dallas, and they're just calling their headquarters Dallas now, probably for tax reasons. And I totally get that. And then this month, this last week, if you read the headlines, they laid off 200 employees in Dallas. So it's not quite as simple as the headlines can make it sound. Another big example is Toyota. A lot of people talk about Toyota moving out, and they also moved to Texas, right? But they left a giant campus behind them. So they don't just leave a hole and it's gone. They have an incredibly valuable, something like 1,000-acre-old campus in Torrance that's right off the 405 in an incredible location that's currently being redeveloped. I just drove past it on Western today, and I thought, oh my God, that's the largest construction project I've seen outside of SoFi Stadium, because it's such an incredible piece of real estate that's going to be repurposed probably into something a lot more useful and modern than the Toyota campus was to begin with. And to Dave's earlier statistics, we have the job growth from other industries, newer businesses and stuff like that to infill the desire for the space as well as the jobs behind it. So
they had a little bit of a higher retention rate when they left, and that's really more of a statement on the nature of Toyota culture versus Nissan culture. But still, at least 50% of those people stayed behind as well. A lot of people's careers ended in Toyota, or they took Toyota still has a huge presence here in Southern California. Even though their headquarters moved, there's still a lot of people that work for Toyota that still live here. And that's just because it's where the port is, right? It's where their distribution center is here. It's where a lot of their suppliers are. So for every company that moves, it doesn't mean every job that they have is leaving the state as well.
Right. Yeah. Great point. Interesting observations. I see Karen joined us. Sorry, Karen, you weren't here when we started off the meeting, but Karen, I'll give her a shout out real quick. She's one of our sponsors. If you're trying to compete really hard out there in this difficult environment, she put her information in the chat, but they do hard money loans and they can give you proof of funds if you need to close super fast with very little contingencies. So give her a call if you're trying to flip right now and see what she can do for you. Other questions, feel free to put them in. We will give it a little bit for them to come in, and then Malcolm is going to give us some breakout rooms. This is the first FIBI Long Beach that we've done outside of the webinar version of Zoom. So webinars don't allow you to really to network or even to see the video of anybody who joins us. So we're going to try doing a couple breakout rooms tonight in a few minutes if we don't get any more questions. And it'll be groups of 4. We'll go for 10 minutes first, and then we'll do a second one for 10 minutes. The second one we'll just leave open. So if you've got a good group and you're having a good conversation, let it rip and enjoy. I'm sure if you reach out to either Dave or I, you can probably get copies of the slides from tonight. That was some incredible information that Dave had, particularly all that economic stuff. That must have been a ton of work to put together. And then we have the source data too. So if you email somebody with Buckingham, we do the research for the multifamily stuff is actually primary research. We pull that out. We pull that off the MLS ourselves, and we correct all the errors in the listings and correct the incomes. And we have every sale in a little spreadsheet. So if you're in that space, it can be really useful. It's not pretty, it's huge, but it's really useful. So with that, if we don't have any other questions.
I think we have one from Peggy.
Okay.
It says, what about the effects of the eviction moratorium on rental property? And have other landlords lost income from tenants not paying rent for many months? Great
question. So the eviction moratorium ended up being pretty effective and fair, in my opinion. I own about 100 units myself, through 15 buildings around mostly Long Beach. Although I'm buying one in Inglewood right now, so I'm branching out. You guys would be so proud. And of over 100 tenants, I had one that took advantage of the eviction moratorium and didn't pay. And the rules with the eviction moratorium are actually that you have to pay 25% of the contract rent every month, and then it converts to consumer debt when the moratorium is over at the end of June. Well, this person didn't pay at all. They totally ignored it and didn't communicate with us at all. So they ended up getting a judgment against them for the UD, and we're about to be evicted, even in the middle of the eviction moratorium, and came back at the last minute and said, wait, okay, we'll pay everything, we'll pay. So they paid all of their back rent, and now we've offered to upgrade their unit and bring them all the way to market, and they'll pay the new contract rent. So that person was obviously taking advantage of the moratorium because they had the money to just give us a check when they were about to be kicked out. But across the portfolio from our property management partner of 3,000 units, very, very few actually have gone all the way. For the most part, they've been working with people and calling weekly who have balances to get promises to pay in writing, which doesn't really do anything. The tenants still don't have to pay if they pay that 25% amount. But you would be amazed at people's desire to make good on their promise to pay and actually pay the rent. I think when this first came out and the moratorium happened, everyone was afraid that every tenant was going to game the system, even if they could pay, and stop paying. And the landlords were just going to get screwed and weren't going to be able to do anything. That has been by far the exception. He's been tracking monthly payment numbers every month. He releases a report every 2 weeks called the Borba Report. His company's called Borba Property Group, and I think you can sign up for it on email if you want. And he brings out the statistics. We've been tracking collections across their portfolio since April, and it's been 93% and higher every single month. And the lowest was right before they reached the last stimulus and in the holidays. December was the worst. And now it's gone way back up in January and February. We're going to be over 95% as we finish February right now. Collections have been really good. I've had a bit of turnover in my units. I was kind of surprised at that I thought, well, if somebody couldn't pay the rent, they would probably take advantage of the moratorium and they would just stay and I wouldn't be able to do anything. But that's not what happened. Instead, they've given us notice to move and have said, I can't pay the rent, I'm moving, here's my move out date, which is totally the honorable thing to do. But I think they know that this is eventually going to catch up with them if they just game it and stay. And instead they move out. We're happy to let them go, upgrade units if necessary, release at market rent. And these things are moving really quickly, similar to starter single family homes. These are 1 and 2 bedroom apartments renting for $1,400 to $1,800. So that's pretty hard to find. We've been really pleasantly surprised at the rental, at the collections rates and the few evictions that we have. There are a handful, unfortunately, that some of our clients have experienced, people that are just digging in. They're not doing anything. They refuse to move. They're paying the 25%. They know their rights and they're not going anywhere. But it's very rare, and that will be over soon. And those people are going to have to deal with it. The other thing that we have is for people that are in that situation, our management company is helping those tenants apply for the rent relief funds. So we had the LA County rent relief program in the earlier days. We had city by city rent relief programs. You had the extended unemployment. Now we have a new rent relief program that has, I think, $1.8 billion for LA County. And you can apply on behalf of your tenants. It pays all of your back rent and any rent that's due right now, up to 80% of what's owed, and you're expected to forgive 20% of the balance. And the payments made directly to the landlord. That was done with SB 91. That's what it's called. If you want to read the details of that, that's the state legislating the way that they're going to use those funds. And that's been very effective. Let's see, Ivan's got a comment on that. My 9-unit in Long Beach, I paid small cash for keys payment to one tenant to move out, bumped the rent by 18%, all tenants paying full. Yeah, so we've seen a lot of that too. We've done cash for keys where people are low, even just forgiving the back rent and saying you can go and you won't have an eviction. I'll forgive the back rent. You can have your security deposit back and you're going to be fine. Audrey has another question. Backtracking to inflation. The last event I remember where the government put such an equitable degree of money into the economy was the bank bailouts in 2008. Were there any side effects from this inflation-wise, or does where the money get distributed matter too? Really interesting question there. So the bailouts in 2008, as I understand it, were actually loans that have since been repaid. And so that was what made that very effective and ended up not causing a major debt issue for the government. We certainly have not experienced much inflation at all since 2008. It's been very low. That's been part of the reason why interest rates have been comparatively low for this entire cycle. So I think it's a little bit different because you're right that the direction the money went for the bailout is totally different. I think it was a lot more effective this time personally, because what happened in 2008 is the banks got bailed out and the regular people were left holding the bag, and there was a ton of foreclosures. We saw what that happened and what that did to real estate values. This time around, they gave a lot of money to the people at the bottom of the food chain, and that allowed them to trickle up, pay the landlords, which allowed the landlords to pay the banks. And that was really, really effective this time. So I think that's a major reason why we did not see what could have been a catastrophic crash this time around. I don't know if Dave has any other thoughts on that question, because it's an interesting one.
Yeah, and I think your slides earlier today about the effect that inflation had on real estate. Even if this next batch does start to jump inflation up, first of all, we're at such a low level right now. But if anything, I think it's going to have a positive impact on real estate.
Yeah, you want to own real estate if inflation comes back. It's the best possible thing.
Yeah.
Looks like Fred's got a question on density for LA lots that I'm sure you're more suited to answer than me. Is there a movement to higher density for LA lots that are large enough for, say, R2, and the current structure is a small house? I have a Westchester listing, 980 square feet, old and all original. Would you be able to scrape that and put up a duplex? That's what we've seen in Redondo.
I'm sorry, zoned R2?
Would it work that are large enough for R2, but it sounds like it's zoned R1 right now. I'm just inferring from the question.
Yeah, so then it's perfect, right? Put the single family house there, add an ADU. You could even add a JADU and make it a triplex. And absolutely, you can, as long as the lot's large enough, there's some setbacks you have to take advantage of. But I mean, clearly, we just talked about we have this huge shortage of housing in Southern California. Another stat that I didn't have in my presentation that I'll probably put in moving forward is, California is 49th in all 50 states on number of residences per thousand. We have a severe shortage of housing. So if you have the opportunity to add more residences to your R1 lot using ADUs, I'd absolutely recommend it. In fact, we've got a bunch of investors. That's kind of their primary strategy. Even some fix and flippers looking for those old fixers with a detached garage, fixing up the main house, converting the garage to an ADU, possibly adding a JADU, maybe even, extending or expanding the existing house by another 30%, and then turning around and putting that on the market. I think you can create huge value these days by using the ADU laws, even in R1 lots, to add more residences and add more density.
Absolutely. And that's available on multifamily parcels as well. That's been really popular in our space. There's lots of duplexes out there that have garages or larger lots. There are bigger buildings that allow it too. The rules are a little different with larger buildings. You can do 2 ADUs on any 3 unit and above. In some markets, they're starting to crack down on duplexes. And then if you get into the bigger buildings, you can add 25% of the unit count as ADUs, but it has to be within the existing square footage. So it's a really interesting strategy.
My favorite transaction that I did last year was with a guy named Anthony Walker, and we had one of his investors bought one of my developer's buildings. It was an 18 unit, and it was spread out over 3 separate lots. And he's now putting in 6 ADUs. So he bought us an 18 unit project. By the end of this year, it's going to be a 24 unit project, and the cash on cash, the returns on that just go through the roof.
It's
so
insane.
ADUs are a huge opportunity all throughout Southern California.
Yeah, that my favorite deal as well, for the record. But yeah, you look at the numbers on that, and my client was like, "What else do you have to show me like this?" And I was like, "Nothing, unless we're going to like Minneapolis or something like that. Like it's not going to happen."
Who would want to go to Minneapolis?
I left Minneapolis 21 years ago. I'm not going back. I think I saw Jeff in here. So
yeah, I see it. He's
I had
kind
to
of
get the jab in.
right now, talking.
I can talk crap because it's my hometown.
There you go. I can just talk crap because it's Jeff.
Yeah. Let's see. Does anybody have experience navigating the owner occupancy requirements for JADUs? It becomes a deed restriction. My understanding is it does, but I have not tried that yet. I don't know if Dave has had one of those.
Not practical, but I do think that is an issue on the JADU. I just like sticking with the ADUs just because I think it's cleaner and easier. The JADU is a small. I think that's more of if you're living in the property and you want to have 2 rental properties. That's where the ADU and the JADU makes sense. If you're just going to build it and turn it into a rental property, I would just make the ADU, keep it like a duplex, and go from there.
Yeah, it's an interesting question. I'm curious what happens to that on resale, right? Because if you have a covenant that it has to be owner occupied, then does it take the property away from the market for anybody who might want to rent it? I don't know. That's a good question.
Good question. Yeah, I think the appraisal market has not caught up to the ADU market yet. Those things are having a hard time appraising, but I think that's going to change in the next 3 to 5 years, just because there's so many people out there that are creating ADUs. We'll finally have some comps for them. And right now, I think the cost per square foot for ADUs is being established because people are waiving their appraisal contingencies. Right. So if a buyer has the same value for that ADU that he has for the house, and he's willing to pay for it, and he's willing to waive his appraisal, well, there you go. There's the comp for the house with the ADU in that submarket that's going to last for the next 6 months.
That's the really tricky thing right now, for sure.
I think we're going to see a lot of that in 2021. That kind of ADU value is going to get established.
Well, I think one of our lenders sent us some guidelines that Fannie and Freddie are instructing appraisers to ignore ADUs in value, which is ridiculous, right? They're totally legitimate. They're permanent living square footage. They can be rented. That's obviously got to change, but it's going to take the market a little while to adjust to that. So as you get into these deals and you're doing ADUs, you may want to consider that for your holding period consideration, right? If you plan on owning them for maybe 18 months or so, because I think what Dave is saying is right, that we need a bit of a history on appraisals to establish value there.
Yep.
Pros and cons of investing in OC versus LA County. That's a good one. I think they're both great. LA County is generally denser. And so when you invest in density, you tend to get strong appreciation. On the other hand, a lot of LA County is LA City. And if you have something that's built prior to 1978, you have strict rent control, much worse rent. It's not strict rent control, but it's worse rent control than Orange County, which just has the statewide version that's pretty mild. I would be open to either market depending on, what your plan is for management, how much you want to put down, and what you like. I think they're both great.
I mean, it's going to come down to supply and demand. I think the same metrics that are happening in LA County are happening in Orange County. It's just more of a preference of where you want to own that property. It's probably at that point in time, look, what's better, a house in Long Beach versus a house in, Huntington Beach. It probably depends on the house. I don't think the county really has anything to do with it.
Yeah, definitely.
I'll take this question on the off-market stuff, because I think that's something that happened in 2020 that's different. Off-market has become really hard these days, and that's because CAR put on a bunch of rules and moratoriums on us realtors on how we market off-market properties. There's been so many lawsuits from different people saying that, Realtor A didn't get me top dollar because he sold my property off market. He didn't expose it to the entire market. Therefore, I'm suing them. And there's been so much litigation in that. And to capitulate, basically what CAR did is they put in some new rules that now us as realtors, when we have a listing, we have to put it on the MLS. And there's a new status that's been created called coming soon. So for people that are looking for off-market deals, what I suggest you do is search for coming soon deals, because those are properties that, maybe the realtors got the listing, the house is getting a little bit of work done, and the before they put it on the market and put it active, it stays in coming soon status. There might be an opportunity, especially if someone's getting some work done. Maybe they want to paint it, maybe they want to carpet it, and you're going to just be like, look, I will take the property as is, where is, no contingencies, don't even put it on the market, don't spend another dime. You might be able to pull that deal off. So
Yes.
that's one of the things that I think is affecting the off market. If there's a realtor involved, it's going to be really hard to get an off market deal unless you're going direct to sellers and you've got some kind of, marketing engine to get you leads that'll get you directly to sellers. It's going to be really hard to find off-market deals.
In the multifamily space, it's a little bit different. So not all brokers, especially the brokers that focus on the larger deals, not all brokers are realtors. Many of them are not members of CAR or NAR. And they do that deliberately so that they're not bound by those rules. And the multifamily space it's the Wild West of cold calling is what that is. And so if you own a 5-unit and up apartment building, first of all, I'm sorry for what happens to your phone every day on behalf of my competitors. But what these guys are doing is they have these giant machines of young brokers who are spending all day cold calling for owners for deals. And if they often don't have listing agreements, and so because they don't have a listing agreement, it's not an off-market listing of theirs, but they will call owners, source deals, and bring them to clients that they know. And so to get those, it's very difficult if you're competing against giant companies that have banks of people sitting in cubicles doing cold calls. So in my experience, if you want those types of deals, you need to have relationships. And that's where they come from. You just have to be in the market for long enough, let people know what you're looking for. And you might get a crack at something, but generally, we usually recommend that sellers put their listing on the public market. You tend to get the best price. So it's a tough topic. Okay. Give it a minute for other questions. Malcolm in the wings, preparing for our breakout rooms. Thank you everyone for joining us. Here's another good question. Unprecedented time. Every market is hot. Gold, stocks, lands, small town, Main Street, sneakers. It's all, great. It's a good point. Buffett says buy when others are in fear, but what market is scary right now? That's a perfect segue for a preview of the FIBI Long Beach that I was able to schedule for our April meeting. You want to know what's scary right now? Office and retail. That's the scariest one. And hotels. So great question. I think, that's where the distress is going to be and is right now, especially as some of these funds start expiring. I have a colleague that is very accomplished. She's a CEO of a company called LDC Advisors. Her name is Fran Morgan. She advises giant companies, pension funds, hedge funds, private equity companies on major development projects all over the country. And she is going to be our guest speaker for our April FIBI Long Beach event. And we're going to talk all about reuse possibilities. So ideas about changing the use of something like an old office building or a retail strip center or a hotel or a golf course into residential, which is obviously super popular right now. So she has a ton of experience on doing that on a huge scale. I'm really interested to talk to her and have a conversation about everything that's involved, because I'm looking at doing a deal like that right now. I actually own an office building that I decided I don't want anymore in Torrance. And I was just going to sell it for whatever price it was going to go for. And I'm actually trying to see if I can convert it to a apartment building right now. So I'm going to be my own guinea pig on that strategy, but I'm really interested in the possibilities for rezoning and reuse opportunities with some of these older parcels that we see all over the place. So she's going to be our guest speaker on April 22nd. Make sure you're there. We got to get somebody for March still, but she's available in April. So that'll be a really interesting topic. So I hope you can join us. So with that said, Malcolm is going to split us into breakout rooms. We'll have one of them for 10 minutes and then another one for an indefinite amount of time. If you're having a great conversation, thank you everyone for joining us tonight. It has been a great conversation. Thanks so much for Dave for doing all of that research, incredible data. Love it. We'll do it again so we can keep everybody updated sometime soon. If I don't see you in a breakout room, we'll see you next month.
Awesome. Thanks, everyone. Thanks, Anthony.
So every breakout room is going to have either 5 or 4 people. And your first topic, we have a little icebreaker topics here. The first topic is, what are you working on in 2021?